What's going on YouTube? It's Gan Mo. So you always hear about real estate investments, purchasing real estate, get into real estate. But how should you be purchasing your real estate investments? And that's what we're going to be talking about in this video. Financing your real estate investments. So without any further ado, let's dive right into it.
Now, rental properties are a great way to invest your money and to supplement your income. But one of the biggest obstacles when it comes to real estate investing is figuring out how you're going to finance those properties and use leverage on your side. Now, owner-occupied properties are much easier to finance than investment properties, and typically those investment property loans will cost you more. Now, in the eyes of the bank, from a risk standpoint, underwriting an investment property is a little bit more risky than underwriting a primary home, as in if you're going to be living in that home. As such, they make the lending requirements a little tougher. They require higher credit scores, they require higher down payments, and they also require higher incomes for the borrower. As such, they are trying to minimize and mitigate the risks on the investment.
It's important to clarify what exactly is that you are purchasing. Are you purchasing an investment property or an owner-occupied property? So an owner-occupied property is a property that you plan on living in for more than 6 months out of the year. Not just some property you want to buy as a vacation home for 1 week out of the whole year.
Now, that classification is particularly important, and you want to make sure you specify to your underwriter if you're purchasing an investment property or a primary home. Because if you're trying to pass an investment property as an owner-occupied property, well, that's considered frauds, my friend, and who wants to get into that? And if you're trying to pass a HUD home, HUD, you're actually going to be facing some prison time because that's considered a felony. And as a healthcare provider, you actually might lose your license for that. So please shy away from that. But there's some good news. Stick around till the end of this video and we're going to show you how you're able to convert that primary home into investment property.
Now, our government favors primary owner-occupied homes. And why is that? Well, they have an incentive for them. FHA loans, conventional loans, USDA and VA loans. You can get into your first home or second home for as little as 3.5% down through an FHA loan. USDA and VA loans, 0 down. No money out of your pocket. And conventional loans, anywhere between 3 to 5% down. And on top of all that, you can apply for down payment assistance programs, which, credit score of 620? It doesn't have to be all that. So that stimulus check you just got in the mail for that family of 5 for about $3,000, get your first home with that.
You hear this all the time. Do not buy a house if you're in residency or in school. But with the down payments being so low, why not? You can rent that house after. Keep in mind, if you live in that house for 1 year and then rent it out, you are able to take advantage of that loophole where you're actually buying a primary home and you did not commit any fraud. Now, if you live in that house for 2 years, you can actually sell that house and all the profits are tax-free. On the other hand, financing investment properties is a lot more challenging. They typically require between 20 and 35% for the down payment. They also require higher credit scores, typically 720 and higher. In addition to all that, they also want lower debt-to-income ratios. And they make it super hard for you to be the next Grant Cardone. And most big banks limit you to 4 properties total. And if you're lucky, you can go to one of the smaller banks and they might give you 10 properties. So how are you going to be getting to 100 properties if you want to? But have no fear, Dr. Gan and more are here, and there are options out there for investors to hit their investment goals.
So before we jump into those financing options to show you how to get above that 4 or 10 investment property threshold that Fannie and Freddie limit you on, remember, your job is to go to the bank and prove to them you are not a risky proposition to them. So they like to look at debt-to-income ratio. So let's break that down. Now, debt-to-income ratio is the amount of money you make each month compared to your debt payments each month. And every bank has different limits on their debt-to-income ratios. Now remember, the debt-to-income ratio does not take into account the total balances of your mortgages, only your debt payments each month.
There's 2 ways to improve that ratio. Either earn more money, you have to work longer hours, or pay off some of those balances or eliminating off of your books on a month-to-month basis so they don't negatively impact you. Because as you're going to finance additional properties, they are going to be taking that debt-to-income ratio into consideration, and they are requiring a lower number as you purchase more properties. In the very beginning of your investment career and throughout your properties 1 through 10, they might be looking at a 40 to 45% debt to income ratio. But once you get over 10, now that's a whole different animal. As of recently on some of the properties that I was looking at, they were asking me for a 30% debt to income ratio. Now that's hard because every payment and every mortgage I'm adding onto my books does increase my debt balance. And as such, I have to compensate for it by cash flow or a higher income.
Now, what are the other factors these underwriters look for in providing you with that loan? Well, they want to see that you have a stable job. And as healthcare professionals, we tend to have a very stable career. They want to see that you've been at your employer for at least 2 years. They want to see a good credit score. Now, yes, you may have a decent credit score, but remember, the lower credit score, that comes with higher fees and costs. So they typically want to see a credit score between the 680 to 720 range to get you a good loan.
And lastly, they're going to be asking for your tax returns, and that's how they're going to verify that you actually do have an employment or if you're self-employed and generating actual revenue. But one thing to keep in mind as a self-employed person, do not expense your entire income trying to save on taxes, because guess what? You're going to be left over with no income and a whole lot of debt. And guess what? Your debt to income ratio is going to look real bad. And one thing that's very often overlooked are the cash reserves, aka the cash on hand. Most investors or people getting into real estate assume that they just have to come up with their closing costs along with the down payments. But they will want to see your cash reserves, as in 3 to 6 months worth of cash reserves or cash on hand to service those mortgages. And as you acquire more properties, once you hit that 10 property point, they might ask you for a whole year worth of cash on hand to make sure you don't default on any of those properties.
Well, all this information is great, but onto the fun stuff. Where can you finance these investment properties? Well, if you want to finance investment properties 1 through 10, you could go to some of the big banks like Chase, Bank of America, TD Ameritrade, Wells Fargo, and you could get a loan through them. But if you want to go above that 10 investment property threshold, big banks have very strict guidelines because they're set by Mr. Fannie and Freddie, because most of those loans are sold back to Fannie and Freddie and Wall Street. So you could go to the smaller banks. They're a little bit more flexible because they don't have to sell the loans back to the investors. And those type of banks are called portfolio lenders.
Now, for those investors who don't fit the guidelines set by Fannie and Freddie, they might want to look at some hard money lending or some private money. And that really all depends on your connections and who you know.
Time to go pick up that phone and make some phone calls, ring some doorbells, and pull on some chains right there.
Now, the best advantage of those loans is that they are immediately available, typically within 48 to 72 hours. And they typically will be able to finance you for 100% of your purchase, depending on the deal that you negotiate with that hard money lender. Now, these loans are very well suited for short-term holds. If you're trying to keep a property for 1 year or less, think about a flip, for example. Or if you're trying to get that money in your hands as fast as humanly possible because you're getting a steal of a deal. But one of the major drawbacks is that they come with typically higher fees, as low as 8% and as high as 15 and 20%, which is a lot of interest to pay on a yearly basis. That's why you don't want to keep those loans for too long. The best way to go about it is get that money, then refinance that loan at a later time. And also, those loans are typically associated with origination fees between 1 and 2%.
So with all this information, what is the best type of loan for an investor? Well, there are pros and cons to all different types of loans. So the real answer here is there is no best option. It's based on you, where you are in your investment career, how much cash you have available, what kind of experience do you have in investing in real estate?
Are you trying to flip a property? Are you trying to hold a property for the long terms? These are all factors that play into what type of loan that you're looking for. But your first step is calling your local lender. Find out what products that they have. And not just one lender. Call as many lenders as humanly possible. Because for every bank that you're dealing with, they might fit different criteria. It might help you with financing a different deal that you're trying to acquire. As such, lining up all those financing options is only going to come to help you down the line.
So we hope you found this information helpful. Don't forget to leave a comment down below. Gingerly tap that like button, and we'll see you next time.